Ticker symbol AVGO is up over 100% in the past year. And today we'll be looking at what potentially may be a large cap which is mainly being driven by AI hype. This is a troubled growth machine because its revenue has actually grown by 32% year over year. However, they have consecutive quarters where their net margin has actually contracted. So today we'll be looking at Broadcom, a semiconductor company. In their annual report, they state that they're a global technology leader that designs, develops, and supplies semiconductor and infrastructure software solutions. In plain English, this basically means that they design semiconductors, which are basically tiny chips which are used in computers, mobile phones, and all other type of electronic devices, and software solutions that help companies manage their technology infrastructure. The reason why their revenue has been experiencing this massive growth is because one of the main uses for their products are data centers. And in these recent years, there has been a complete boom of data centers in order to account for the cloud and for the new AI technologies. Their sales of the top 5 customers currently account for 35% of their total revenue, where Apple makes up 20% of their total revenue. And this is one of the major red flags that I have seen for this company, because although it is very good to have Apple as your biggest clients, as they are a client that has a very high volume and they can pay a lot more than the average customer. If this agreement is put into jeopardy, they could lose over 20% of their revenues, which would be a massive downbeat for the stock. However, there have been no signs of that happening. Now, Broadcom has stated 3 main drivers of their growth, where the first one actually involves acquiring leading companies through strategic, well-financed acquisitions. Now, I'm not the biggest fan of a company outlining that their biggest priority for growth is acquisitions, because this will then go against our thesis of actually growing their revenue organically. But we'll talk about that later on. Number 2 is to invest heavily in research and development to maintain their technology leadership. And number 3 is to focus on delivering a broad suite of infrastructure technology products through a unified sales and administrative platform. Now, this company has a 9% return on capital employed, which I'm not the biggest fan of, because usually our threshold for this metric is above 15%. However, they do have an interest coverage ratio of above 10 times, a very solid cash conversion of 97%, a very healthy profit margin of 64%, and an operating margin of 11%, which has been decreasing quarter after quarter, where we can see that their revenue has been experiencing significant growth, where it has even risen by 32% year over year. However, I don't think that this is a good thing, because on the other hand, we can see that their net income has actually been decreasing. This phenomenon where your revenue is increasing so everything looks good, but then your net income is actually decreasing, I'm not a big fan of, because at the end of the day, us investors, what we get is free cash flow, and free cash flow is more correlated to net income. And as I always like to say, it's not about who makes the most amount of money, it's about who is able to keep the most amount of money. And as a consequence, the efficiency ratios have actually been decreasing in the past quarters as well, because these are more heavily linked with net income, where return on invested capital, which is the one that we like to focus on this slide, has gone from a 40% to a 20%. This is still above our threshold, but this raises a huge question. Will this trend continue? Now, in terms of their leverage analysis, they're doing pretty solid. All their total assets are way above their total liabilities, so I don't have any major concerns on this side. Now, when looking at this company's fundamentals, it gets a solid 6.5 out of 8. First of all, they have very low liability risk, as they actually have an interest coverage ratio of above 10 times. They have a very solid balance sheet, as they can pay all of their short-term liabilities by only using their current assets. They're very consistent with their free cash flow generation, and I was extremely surprised that they were actually growing organically because their net income has actually fallen in the past quarters. However, this is being funneled by their organic revenue growth, and I was not actually able to find an explanation of why their free cash flow is growing so consistently when they're having issues with their net margins. Now, they do pay dividends, which is a very solid point on their behalf, but their shares outstanding have been increasing recently, diluting shareholders a little bit. Now, the most important point from the slide that I always talk about is their existing moat on competitive advantage, and in this case, Broadcom actually excels at this. it is not the biggest and not the best semiconductor company, because you have some huge giants such as Nvidia or, for example, AMD. However, Broadcom has a huge competitive advantage over other competitors because it has reached a scale and a size that allows it to create barriers to entry for other type of competitors. Producing semiconductors is not something cheap, and right now they're doing it a lot better than the majority of the market. Additionally, Broadcom offers some of the highest performing products for some niche situations. For example, when it comes to Wi-Fi, Bluetooth, and all those types of technologies, Broadcom excels at this, and they have almost no competition in this aspect. So this is where some of their existing moat and competitive advantage actually derives from. However, I did not actually find enough reason to convince me that they have pricing power. Now, to me, the definition of pricing power is being able to charge higher prices every year to your clients without actually losing a lot of them, to the point where your revenues will actually increase because the price increase will overcompensate the decrease in active clients. In this case, the reason why I don't believe that they have a lot of pricing power is because they're not the largest, not the most innovative, and in some cases, not the company with the highest performance. Currently, the technology advancements in this industry, apart from improving the performance of the semiconductors, they're decreasing the prices of these a lot. And if Broadcom is not able to actually keep up with their peers and developing semiconductors that are performing significantly better than any of their peers, they will actually suffer these price decreases, and I believe that that may already be happening and is the reason why their net income is decreasing. And over here we can see that their dividend yield has been decreasing for the past year, but this is not because their dividends are performing poorly, this is because their stock is up over 100% in the past year. Over here I do see one red flag if this number is reasonable, which is that their payout ratio is over 175%, and this of course may be one of the issues from their net income actually decreasing by so much. This dividend is not sustainable. In regards to their valuation analysis, we can see that it has been clearly the AI hype which has overpriced this company, because if we compare their historic PE ratio, they are extremely overpriced right now, trading at a PE ratio of almost 150 times, where last year they were trading at a PE ratio closer to around 25 times. In regards to their free cash flow yield of 2.31%, when comparing this to the long-term inflation rate of 3%, it does look overvalued as well. In regards to the risks and possible challenges, I first of all see their performance risk and them not meeting performance objectives, and here the main risk that I'm outlining is their dependency on Apple. Apple, as we have seen, represents around 20% of their total revenues, and although this is a great company, they have recently been deciding to go their own way when it comes to semiconductors and other technologies. If they decide to eliminate Broadcom from their mix, Broadcom will suffer massively and their revenues will decrease, affecting their net income even further. Also, this company is extremely cyclical because it depends heavily on market spending on new technologies. So I would have these two risks in the back of my mind. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that they have a strong competitive advantage and I believe that they have consistent cash flows which are growing at a very predictable rate. However, they have very low return on capital employed and their margins are contracting. So although I believe that this may be a good investment, I believe that it is very risky due to their margin contraction and their extremely high valuation. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content.